Hello everyone, and welcome to our video lecture for Chapter 17, Corporations, where we're going to discuss an introduction and operating rules. So first, let's just start with the similarities between corporate and individual tax treatment. So gross income of a corporation and that of an individual are very similar, right? We still have compensation for services, we have income from trade or businesses, gains from property, interest, dividends. All of that is about the same. The corporate taxpayers are allowed fewer exclusions, and non-taxable exchange treatment is similar for both corporations and individuals. Business deductions of a corporation and individuals are also very similar. But we do have several dissimilarities. So there are different tax rates. So individuals are subject to AMT, alternative minimum taxes, while the corporate AMT was repealed with the TCJA in 2017. So in general, all expenses of corporations are business deductions. So the corporation does not calculate AGI, adjusted gross income. Corporation is not allowed a standard deduction or itemized deductions the way an individual is. The deduction for qualified business income does not apply to corporations. In addition, the TCJA of 2017 adds a limitation on the excess business losses of individuals that does not apply to corporations. So here's a comparison of corporate and individual tax treatment, so you can see how corporations come up with their tax due, and you can see how that is a bit different from the individual's tax due. So we're now going to move on to compare specific provisions. So in comparing the income tax of individuals and corporations, we have several key differences: accounting periods and methods, capital gains and losses, the recapture of depreciation, the business interest expense, their limitation, passive activity losses, charitable contributions, executive compensation, NOLs, net operating losses, and special deductions that are only available to corporations. So let's start with the accounting periods and methods. So most C Corps can use a calendar year or a fiscal year ending on the last day of a calendar month for either 52 or 53 week year. S corporations and PSCs, personal service corporations, are restricted in the use of a fiscal year. So as a general rule, the cash method of accounting is unavailable to corporations unless that corporation is an S Corp or that corporation has engaged in the trade or business of farming or timber, unless that corporation is a qualified PSC, and the corporation with an average annual gross receipts of 26 million or less for the most recent 3-year period. So in general, entities that maintain inventory for sales to customers are required to use the accrual method of accounting for determining sales and cost of goods sold. So the TCJA of 2019 allows entities with average annual gross receipts of 26 million or less for the most recent 3-year period to use the cash method when they account for inventories. So the TCJA of 2017 modifies the rules regarding the timing of gross income by accrual basis taxpayers. Generally, they must recognize gross income no later than the tax year in which such income is included in income for financial statement purposes. So this codifies prior law that allows accrual taxpayers to elect to defer income inclusion of advance payments for goods and services to the end of the tax year following the tax year of receipt. Related parties. So in an accrual basis, corporation has an accrual outstanding at the end of any taxable year with a related party. It cannot claim a deduction until the related party reports the amount as income. So now let's move on to capital gains and losses. So for individuals, the net capital gain subject to the following preferential tax treatment, right? So if you have net short-term gains subject to regular tax rate, but then you have net long-term gains that are taxed at the maximum rate of 15% or 20%. So then we have net capital losses deductible up to $3,000, which remainder carried to future years. So carryovers do not lose their identity and they remain either long-term or short-term. So corporations have no special tax rates applicable to capital gains. So the entire gain is included in the income and it's subject to normal corporate tax rates. And corporations cannot take a deduction for net capital losses. Capital losses can be used only to offset capital gains. And any unused capital losses can be carried back 3 years and carried forward for 5 years. And all carried over losses are treated as short term. So now let's talk about depreciation recapture. In general, the recapture rules are equally applicable to both individual and corporate taxpayers, but corporations may have more depreciation recapture, which is ordinary income, on their disposal of Section 1250 property than individuals. So under Section 291, a corporation has additional ordinary income equal to 20% of the excess of depreciation recapture that would arise if the property was Section 1245 property over depreciation recapture computed under Section 1250 without regard to Section 291. So now let's talk about business interest expense limitations. So the TCJA of 2017 limits the deductions for business interest expense to the sum of the taxpayer's business interest income for the year, 30% of the taxpayer's adjusted taxable income for the year, and the taxpayer's floor plan financing interest for the year. There are amounts that are disallowed, but that may be carried forward and used in future tax years. So this does not apply to taxpayers with average gross receipts from the prior 3-year period of $26 million or less. And that is for taxable years beginning in 2019. So business interest income is the amount of interest income includable in gross income for the year, which is related to a trade or business. And all interest income and interest expenses of a corporation is assumed to be part of the corporation's trade or business. And then we have adjustable tax income. So taxable income is computed without regard to any non-business income, gain, deduction, or loss, business interest or business interest income, NOL, net operating losses deduction, a deduction for qualified business income, and lastly, a deduction allowable for depreciation, amortization, or depletion. Moving on to passive activity losses. So passive activity loss rules apply to individuals and personal service corporations, PSCs, and they cannot offset passive losses against active or portfolio income. For S corporations and partnership, passive income and loss flows through to the owners and rules are applied at the owner level. But for closely held C corporations, they may offset passive losses against net active income, but not portfolio income. Moving on to charitable contributions, both corporate and individual taxpayers may deduct charitable contributions in the year that it's paid. So there are exceptions for accrual-based corporations that allows the deduction in the year preceding payment if it is authorized by the board of directors by the end of that year and if paid on or before the due date of the corporation's tax return. So that would be like the 15th day of the 4th month following the close of the taxable year. And an amount is deductible for property contributions depends on the type of the property that is contributed. Long-term capital gain property deductions is equal to the fair market value of the property, but there is an exception. Corporations may only deduct basis if tangible personal property is contributed and not used by the charity in its exempt function. Long-term capital gain property deduction is also equal to the fair market value of the property, and as you guessed it, there's an exception. So that's the deduction for property contribution to certain private non-operating foundations is limited to the basis in that property. Ordinary income property deduction is equal to the basis in the property and a course, there's an exception. So the basis plus 50% of appreciation can be deducted for corporate contributions of inventory or research property, which is used by the charity as required by the code, but the deduction is limited to twice the property's basis. And corporate charitable contributions deduction is limited to 10% of taxable income before the charitable contribution deduction, before the NOL, the net operating loss or capital loss carryback, and before dividends received deduction. Contributions in excess of 10% limit can be carried forward for 5 years, and in the carryover year, the current year's contributions count first against that 10% limit. Moving on to excessive executive compensation. So in general, Section 162 limits the deduction amount of a publicly held corporation's compensation to any covered employee to $1 million annually. And covered employees include the principal executive officer, the principal financial officer, and 3 other most highly paid compensation officers. In general, this 1 million limit applies to compensation, commissions based on individual performance, and performance-based compensation. But before 2018, the $1 million limit excluded compensations and performance-based compensation. But contracts in place as of November 2nd, 2017 are grandfathered in as long as there are no material changes to that contract. So the limitation of that $1 million also does not apply to retirement plan contributions or employer-provided benefits, which are excludable from gross income by the employees. So for example, their healthcare benefits. And we have reached the end of our PowerPoint. I hope you enjoyed learning all about corporate tax.